Good evening, everyone. I hope my voice is audible to all of you. May I get a quick confirmation over the YouTube chat box? Am I audible to you? Okay. Good evening, everyone. I hope my... Yes. Quick yes. That's great. Okay. So guys, we are going to start with our session today. Let's understand that what are the changes which are applicable in SBR from September 2025. That is your attempt. Now, these changes, they feel very like, if you have some idea of what are the changes, they feel very heavy. So first of all, there is an introduction of IFRS 18. So this is a new standard which was recently introduced in 2024. And it is a replacement of IS1. Now, those of you who have actually studied the SBR syllabus, like who are studying with me, you guys know about IS1, right? You must have studied it, or if you have given SBR in the last attempt, you know what is IS1. It talks about presentation of financial statements. It talks about aggregation, disaggregation, presentation, classification. So all those things are now not tested. But it was not, we never focused on uh, okay, we never focused on IS1 a lot. In our studies, we never focused on IS1 a lot. It just existed, right? It was still there. Now, what we are supposed to do in IFRS 18, okay, what we are supposed to do IFRS 18 is also the same. So I am replacing something which was very less, prominent, but it still existed with something which is obviously not that much prominent as well. So we are going to discuss it. Okay, it seems to be a very big standard, very difficult standard, but actually it is very cute little standard. And if you have done your syllabus of SBR already, this is the right time to cover this concept. Okay, this one is also introduced in FR. So the only change in financial reporting is introduction of IFRS 18. So if there's any FR student who would watch this video, they can also take help from the explanation of IFRS 18. So, since you've covered your syllabus or you are towards the end of syllabus completion, now we will do IFRS 18. And as you know, tomorrow it's 1st of August, and we are going to begin, okay? We are going to begin with our Super 20 sessions and the crash course. So whenever I will be solving case studies with you in the class in the upcoming month, I will refer to IFRS 18. So it's like you first completed the full syllabus, you got to know about the new standard today, and then from the practice part onwards, we will start understanding its application part as well in the past papers. And of course, the people who are sitting for advanced audit and assurance should also refer to this video, because they are also doing the, IFRS application in audit and assurance. So it is relevant for FR students, SBR students, and AAA students as well. And if anyone who is interested in IFRS 18, for example, diploma in IFRS. So let us understand. Let's begin. This is one of the technical articles which is issued by ACCA on IFRS 18. So let us start understanding this new standard. Okay, so this is something which is introduced from in April 2024, but it will be examined from September 2025 onward. So yes, the ACCA and the IFRS, they are not so quick that, okay, as soon as the standard is introduced, we will start applying it in the exams, because first the standard goes through various stages. Like we have an exposure draft on something, then we get comments from the people in the industry, and then the standard is, revised, redrafted, and then a final version is out. And that final version is also not something which you apply today only. Just like there are changes in ACCA curriculum, the number of papers are reducing, so that is not applying from today only, right? It will take time. So everything in real life, when its application begins, it takes time, which is very normal. So let us understand what is there in IFRS 18. If you will attend this session today, there is no need to actually read the technical article if you totally understand this particular video or this particular lecture. Okay. Now, see, mostly everything in IFRS 18 and IS1, like if I talk about the aggregation part, the materiality part, the classification part, they are more or less conceptually same. But what is different is statement of profit and loss. Now, you might wonder that, ma'am, the format of statement of profit and loss has changed. Should we panic about it? And should we be like, oh my God, so whatever we've done so far is gone? No, not at all. The concept is not changed. Only the presentation has changed. Concept of what goes into P&L, why it goes via P&L and not OCI, everything is same. Income and expenses are shown in P&L, that is also same. Ratios that we calculate is also same. It is just the presentation, the way we present our income, the way we present our expenses is different. Now, because the presentation in P&L has changed, if you know, in statement of cash flow, we start with cash from operating expenses, we take a base of profit before tax. Yes or no? Write in the chat box. Do you know this concept? That we have a statement of profit and loss from where we get statement of profit before tax, which is what we use in statement of cash flow as a beginning point. So now, because the presentation here in P&L will change, something in cash flow will also change, which is why ACCA has said in both FR and SBR that we are going to give more emphasis on IFRS 18 and we are going to give more emphasis on statement of cash flow. I'm just thinking that with this change, more or less in question number 1 of SBR, you're going to get either a group statement of profit and loss or a group statement of cash flow. It's just a little bit of prediction kind of thing, okay? And very practical thing, not something that I got a dream yesterday. It's just that it's a very recent change that they've introduced. So they would like to examine you on that. Now, what are the presentational changes in P&L? Now they've said that let's not make P&L a very, for example, in P&L, what do you have right now? What you know from IS1? That I take revenue, I take cost of sales, then I get gross profit. From that, I deduct my non-operating or operating expenses. For example, I can deduct administrative expenses. I can deduct distribution cost, etc., etc. And then I get my, I deduct finance cost. Then I get my profit before tax, then I deduct the tax from it, and then I get my profit for the year. This is what I know from IS1 about P&L. Now they have said, they've made it little posh, it's just like a makeover of P&L. P&L has done a makeup. What is the makeup? They said, let's divide the P&L in various categories. Now, this is not that we are explicitly making the categories as a heading. Okay, I'll show you a new P&L as per IFRS 18. It's not that we are making new headings. It's just that subconsciously we are dividing the categories. First, we will talk about operating category. And then we will talk about investing category, financing category, income tax category, then discontinued operation category. What is income tax category? Anything related to IS 12. If there is a increase in current tax, decrease in current tax, that goes via P&L, so that is income tax category. If there is a change in deferred tax implication, that is income tax category. What is discontinued operation category? You all know about IFRS 5. Nothing new. Whenever there is a discontinued operation, there is a separate line item where we show profit after tax from discontinued operations. So that's what we are talking about here. So these are two useless categories which are quite obvious. And they already had different presentation in IS1 as well. So we are not going to discuss it. But this 3 categories, you have done these 3 categories in cash flow as well. Operating, investing, financing. Now, what goes into operating category? Let us understand that. To understand that, we need to see what goes into investing and financing category. So that's what this particular technical article is going to explain you. Yes, these changes are also applicable in FR. So let's see what are the various categories. So I told you IS 12 and then IFRS 5. Let's talk about investing category. So investing category is used for income and expenses which arise from investment in associates, cash and cash equivalents, other assets if they generate a return individually. What do you mean by that? What is investment? Come on, what is investment? Any asset which is generating, or anything which is generating returns for you. For example, give me examples of investments. You've invested in a company, so maybe you have shares in a company. That is your financial asset. That's an investment. Then you have invested in debt of a company, debt instrument, which is a financial asset. That's an investment. Then if you have maybe you've invested in a company which is your associate, that is also an investment. You will generate returns out of it. And this is not related to running of your business, right? It was never so that you had to buy an associate because you wanted to run your business. So this is what we understand. Investment property, yes, very good. Investment property, even that is something which is investment. So I need to understand that in investing activities, for example, any income or expense, we are talking about P&L, so we are talking about income or expense related to investments which are not necessary for running of the business. What are the investments not necessary for running of the business? Buying shares, buying a company, associate, my debt investments, everything of that sort which generates a return which is not required for business. Okay, so that is something which is classified under investment activity. So dividends that you receive, fair value gains which go via P&L. For example, in investment property, we follow IS 40. In that, under the fair value model, you follow fair value through P&L. So fair value through P&L. So fair value movement of an investment property will go under investment activity. Then similarly, under the same IS 40, if you are following cost model, there you do depreciation of that property, investment property. So that depreciation of investment property also goes under the investment activity. So once I have classified an asset as investment asset, once I've classified a transaction as an investment activity, anything related to it, whether it's an income or an expense, depreciation or a fair value movement, dividend or depreciation, impairment or amortization related to that asset is going to go via investment activities in the P&L. Yes, joint venture is also your investment, right? So let's read it. This means that income and expenses such as interest, dividends in relation to investments, rental income, depreciation, and gains or losses on disposal in relation to investment properties, that is not PP, fair value gains and losses, share of profit or loss of associate will all be included in investing category. So already these things were going via P&L only, right? We are just classifying that this income or expense is coming from an investment asset. It is coming from an investment. That's why investment activity. How do you understand this? Do you understand this very simple classification? So if I have any investment property, if it is depreciated, it's via investment activity. If it is amortized, any intangible asset held for the investment. So maybe I can't think of any such intangible asset maybe, but let's talk about your equity financial instrument. So it's fair value changes that are also going by investment activity. any interest which is that you have received, okay, on debt instruments, that is also going via investment activity. So it is based on what you see in the case study. You will be asked to tell that which activity it is going through. So in question number 1, you might see that there is a pre-populated spreadsheet, okay, and in that they have done incorrect classification. So for example, they have taken the depreciation on investment property under operating activity. So you will say this is wrong. Let's remove it from there and put it in the other row of the spreadsheet. Yes. So this is something which is there in investment activity. Do you understand it? I want your confirmation on the chat box. Yes, the changes do apply to AAA as well. Do you understand this? Investment activity. Okay, that's great. Let's move on to financing category now. Pay attention to it. What is financing category? What is finance? When you raise finance, that means your liability. For example, give me examples of liability. My liability under IFRS 9, when I have issued loan notes, then I have lease liability, then I have deferred tax liabilities, tax liability. I'm not going to talk about that. Then I have maybe my something related to a provision, right? So something, anything related to a liability, okay? So for example, issue of loan notes. All these income and expenses are going to go via the financing category. You've taken a loan, even that. So any interest that you pay on that loan, or any interest that you unwinding of interest on liabilities. And then there can be so many such instances, like if you remember IS 32, we have done so many questions where we say whether it is equity or whether it is liability. And when we conclude that it is a liability, any income or expense related to that liability is going to go via financing category. So these include bank loans, issue of loan notes, income and expenses from initial and subsequent measurement of these liabilities, including derecognition, are reported in financing categories. Interest expenses, financing category. Dividend that you pay, that's your expense, is financing category. Redeemable preference shares are also a liability, so their dividend is also financing category. Then there are some liabilities which arise from transactions which do not involve finance. For example, lease liability, decommissioning provisions. So any interest that you unwind on those provisions, on those particular liabilities, are also going into financing category. Okay, simple. So anything which is related to liabilities apart from tax liabilities are going via financing activity. Okay, then comes operating. Operating is simple. It's related to your running of the business. So your expenses, for example, if you have a depreciation on property, plant and equipment, why do you need the property, plant and equipment? You need it for running of the business. So it will go via operating. Your revenue is an operating income. Your cost of sales is an operating expense. So everything apart from investing and financing and tax and discontinued operations is operating. It basically depends upon what is the nature of your business. We will discuss certain situations that, for example, nature of your business is to give or lend money to others. So maybe your work is that you are a bank or you are a financial institution who actually gives out loans to people. So now in that case, what is your operating activity? Your operating activity is giving finance. That will be not a financing activity for you. I mean, this is quite same as IS 7, right? That's what we have done in IS 7 also, the classification between operating, financing, and investing. It's same. Okay. As a result of issue of IFRS 18, the statement of profit or loss most likely to be more detailed and additional line items. However, it is not considered a significant impact to prepare or be presented with IFRS statements in the FR exam. So it's not that in FR you will be asked to, to make the P&L on the basis of this. Okay. So there is not a significant impact on FR, but you should be aware. So you should be especially aware of guidance given in the scenario as to whether an income or expense should be presented. This is not a new concept. It exists in historical exams. So this is something that you've done in statement of cash flow of IS 7. You know about the classification between activities, right? Okay. Let's talk about subtotals. What are subtotals? So it's like currently under IS1, I have a subtotal of gross profit. Then I have profit before interest and tax. And then I have profit before tax. And then I have profit for the year. These are the subtotals that I currently have. Now, gross profit and profit before income taxes are not mandatory subtotals. However, many entities will present these as additional subtotals because they are necessary. So basically, this is something which is necessary. Okay, subtotals which are not like, these subtotals are not so necessary, but still you can provide them as additional subtotals. So pro forma is given to you like how your P&L would look like actually. Let us see how your P&L would look like. So this is your statement of profit and loss. First, you have income and expenses from operating activities. You have revenue, you have cost of sales, then you have gross profit. Then you have other operating income, other operating expenses like selling expenses, research and development expenses, general and admin expenses, goodwill impairment, other operating expenses. Then you have operating profit. Then you have investment activities. For example, share of profit or loss of associate and joint venture, other investment income. Then you have financing activity. Okay. For example, unwinding of interest and stuff. Then you have income tax expenses. And finally, discontinued operation. And then you have profit for the year. So what are the subtotals that you have? Number one, gross profit. Number two, operating profit. Then profit before financing and income tax, then profit before tax, and then finally profit for the year. So these are the subtotals which we have, right? So this is something that you should remember. These are the subtotals, or this is the kind of P&L that you are going to find in the exam as well. Now, this is for SBR students, you know that in SBR, we are given a pre-populated spreadsheet. So this will already be made for you. You're just supposed to adjust it, right? You will be asked to adjust it. They might have put, for example, selling expenses, they might have put here. So you will say, no, this is wrong. It should go here. They might have misclassified. How simple. So they might have put something like impairment of investment property in operating expenses. It is very normal for you to see impairment of investment activity in operating expenses. But since this IFRS 18 is newly introduced, you will actually take it out from operating activities and put it in the investment activity. This is what we have in the crux of IFRS 18, like, what you guys should know from the basis of IFRS 18. So first tell me, are you guys clear till here? Do you understand it? The division of activities, do we understand it? So till here, this is something which was for FR as well as SBR. Now let's move on to SBR perspective. Okay, ma'am, but goodwill arises from investment in subsidiary, right? So, but would goodwill impairment not be under? No, Rudrapriya, you are investing. If you're talking about consolidated financial statements, so in consolidated financial statements, your goodwill is helping you in operations. That's why it is allocated to CGUs. But in individual accounts, you are correct. It's your investment activity. So you have to see what you're preparing. The extract that I showed you was from consolidated financial statements. I hope it makes sense to you. Okay. Now let's see what SBR perspective is. Same, we have the classification of activities, right? And we have the same discussion here of financing, in operating and investment. Okay. Now, where should candidates report foreign exchange differences in the exam? Now, this is like your IS 21. Yes, Apurva. This is from IS 21. Where should I take my remeasurement, or where should I take my exchange differences? See, exchange differences will depend. Which exchange difference? Is it related to property, plant and equipment? Then it will go into operating activity. If it is related to some investment that we have made, maybe a financial asset, then it will go into investing activity. If it is something related to a liability, like a loan liability, then it will go into financing activity. So there is no specific area from where or to where I have to take my exchange difference. Whatever is the asset or liability in question related to which I have an income or expense, I have to see whether that is used in operations, or whether that is for raising of finance, or whether that is actually an investment. Based on that, I will decide that where it will go. So IFRS 18 states that foreign exchange differences are included in the statement of profit or loss in the same category as the income and expenses from the items which gave rise to the foreign exchange differences. This means that foreign exchange gains and losses on receivables would be presented in operating category, because what are receivables? Because you made a sale, you created a receivable. Sale is your business. That's your nature of business. So receivable is what? It's an operational item. So if there is any foreign exchange difference because of receivables, it will go into operating activity. But if it is related to a loan liability, it will go into financing category. So you have to see the base. What is the underlying asset or liability? On the basis of that, we will decide under which activity this gain or loss will go. Now, what are the main business activities and how do they affect the classification? So sometimes, as I said, if you are a bank, okay, so for example, if you are someone who is a portfolio management company, maybe you invest on behalf of people, or maybe you are like a mutual fund company, right? So you invest on behalf of people, and now for you, investments are not your investments. So those debt and equity instruments, okay, those debt and equity instruments are actually your inventories. That's what you do for a living, right? So that's your operating activity. So in very rarest of the rarest situations, you should know that what is the main business activity. So investing in particular type of assets such as debt and equity and investment properties, or providing finance to customers. So if your business activity relates to such things, then the classification will also change. So let us see. For example, let's read it. If an entity has either of these specified main business activities, then it will classify some income and expenses in the operating category, which would otherwise have been included in investing or financing. So for example, you are a bank. So any transaction cost related to maybe issuing a debt, or let's suppose maybe taking a loan, okay, transaction cost related to taking a loan, generally it should have gone via financing activity, because of course if that particular loan was kept under fair value through P&L, then the transaction costs were to be expensed via P&L. So that would have gone via financing activity because it was related to a loan. But since now you are the bank and it's your operating activity to give loan, that will now go via operating activities. So a company may determine that investing in properties is a main business activity. So maybe they are into real estate. They just invest into properties. So in this case, the company should present income generated from its investment properties in the operating category, as well as any income or expenses arising from initial and subsequent measurement of the investment properties and any gain or loss on derecognition. So anything related to investment properties for this company will go via operating activity, because their investment properties are not investment properties but inventory, right? Then you have to take a special note here. This is important. So we are going to highlight it. Let's read it. Income and expenses arising from assets accounted by using equity method, such as investment in associate or joint venture, are always presented in the investing category, regardless of whether investing in these assets is a main business activity or not. Now, they have not given any logic for this. But what I understand is nobody has a business activity of just investing into companies like, as associates or joint ventures and not doing anything else. So you can invest into shares, but associates and joint ventures, that's something like a business partnership, a mild business partnership. So that is your investment at the end of the day. So maybe that's why they're saying that this will always go via investing activity. So this is one little small exception, that even if my business activity is to make investments in associates and joint ventures, still that will go via investing category, right? Okay, so this is the bank example that I've already given you. Let's move on to the next question. You have given examples about how the categories impact presentation in the statement of profit and loss. How else might these categories impact more discursive answers in the SBR exam? See, as an issue of IFRS 18, we are expecting more detail from candidates in their narrative answers. Now, this is what I will teach you in your Super 20 sessions when I'm going to solve questions of the new exam kit with you. So they are expecting more discussion-based questions. So what do they mean by discussion? What discussion can I do in relation to IFRS 18? So whenever I say, for example, I say that this exchange gain will go via P&L. I say it as per IAS 21. Now I will say it will go via P&L in the XYZ category. For deferred tax, I used to say this change in tax liability will go via P&L. Now I'll say it will go into income tax category of the P&L. That is the enhancement of discussion which will happen in SBR now. Previously, we were just telling them plainly, this goes via P&L, this goes via OCI. Now we are going to tell them that this is going to go via this activity or that activity. This we will learn with the time, okay? When we will be solving, or anyone who's doing themselves, if you'll be solving questions now, so whenever you will see, I'm sure you've not yet solved so many questions that you could apply this concept, but now when you will do past paper questions, you will start thinking this way, that in which category will this gain or loss go? You know the 5 categories: operating, investing, financing, income tax or the discontinued operation. So where it will go? You'll think like that. They've given an example. For example, pension plan, IS 19. So in IS 19, we would have expected candidates to write that service cost component and the net interest component are reported in P&L. But now we are expecting that they tell us which category of the P&L. So the service cost, where will it go? Think about it. Where will the service cost component go? Don't read it. See, service cost is related to operations. Net interest is related to financing. Net interest, right? It is related to your pension obligation. It's a liability. So service cost. See, service cost component should go into operating category and the net interest component should go to financing category. Because service cost, it's related to the expenses. What is pension? Pension is an expense paid to the employee. Employee is helping me in operations. So expenses related to operations are going to operating activity. But I've created a pension obligation, and on that, there is a net interest, unwinding of interest, which is happening. I told you that goes via financing category. Right? So this is how you are supposed to think. Of course, when we'll practice questions, we will think like this going forward. Then, how much detail should candidates know about the presentation of gains and losses arising on derivatives? Now, see, what should I do for derivatives? You all know derivatives under IFRS 9. Their gain or loss goes via P&L. But which activity will I take that gain or loss? See, you have to see whether that financial instrument is a hedging instrument. So designated as hedging instrument are reported in the same category as the income and expense affected by the risks of the financial instrument is used to manage. So understand this. If there is a hedging instrument, of course, you have purchased that hedging instrument for an hedged item. Now, if that hedged item is an investment property, so everything related to this instrument will also go via investment activity. If that hedged item is IS2 inventory, then everything related to this hedging instrument will go via operating activity. If the hedged item is a payable or it's a loan, payable is operating, it's a loan. So it will go via financing. So we have to see what is the activity of the hedged item. On the basis of that, we will decide the activity for the hedging instrument. The same is true for derivatives, which are used to manage identified risks. So now, maybe you have not classified a derivative as a hedging instrument, but you have purchased that derivative for a certain risk. For example, if an entity enters a future contract to buy inventory at a set price, it's a forward. It's a future forward contract where you are just setting a future price to buy inventory. What is inventory? It helps you in operations. So the derivative is also helping you in operations indirectly. That's why its related gain or loss will also go via operating category. Right? So gains and losses arising on derivatives which are not used to manage identified risks are reported in operating category. If you just purchased something for speculation, that means you do not have any underlying risk. I did not buy that derivative because I was afraid that the inventory prices will increase. That's why I entered into a forward or a future contract. If I just purchase it for fun, for speculation, then the gain or loss will go via operating category. It's a rule. So rule number 1 was, if we think about the first exception that we did, that even if our main business activity is investing into associates and joint ventures, still it will go via investment activity. And here we saw another exception, okay, that if you are having a derivative which has no nothing to do with identified risk. It is just for speculation. That particular derivative is going to go via operating category. Then what other important changes have been made? Let us understand that. Okay. A key change introduced by IFRS 18 is that certain subtotals, so operating profit or loss, profit from, I told you these subtotals, all of these subtotals should be presented even if they show the same figure. So now, previously it was not mandatory, right? You were sometimes giving the subtotals and sometimes you were missing it. But now it is mandatory. It should be there, the subtotals, right? Then let us see what a statement of P&L would look like. See, you have your revenue, cost of sales, gross profit, other operating, all these are operating activities. That gives you operating profit. That's the second subtotal after gross profit. Then you have investing activity. Then you have third subtotal. Then you have profit before income taxes, profit from continuing operations, and then profit. So this is basically the kind of P&L that we are going to see in SBR question number 1. Same, what goes into P&L is same. It's just presentation, which has little bit being altered. Just the presentation. Okay. Fine. Now let's talk about this. Another important change is that entities are required to determine whether the statement of profit and loss should classify and present expenses by function, by nature, or by both. What is by function? This is, what I've done. This is, what do you think? Is it by function, by nature? What do you think it is? Let me show you. See, what is by function? The one that we saw was by function. So here what I have done is, I have just simply, actually, if you see, I have just simply taken the revenue, cost of sales, gross profit, selling expenses. I've not gone into detail of various selling expenses, or I have not gone detail of various administrative expenses. So I have created a crisp heading and added a lot of things into that. That is when I segregate or present on the basis of function. But when I go by nature, for example, revenue, then change in inventory of finished goods. That is basically cost of sales, or closing stock minus opening stock. Then raw material used, employee benefits, depreciation, amortization, impairment, other operating expenses. So this is by nature. This gives you more classified or more detailed view. So when you present on the basis of nature, it gives you better view. You also have an option of mixed presentation. So some things you can show on the basis of what do I say? On the basis of by function, and some things you can show on the basis of by nature. That will be your choice. So again, it can be by nature or by function or by both. Correct? This is what I have as my one more small change in the way we present our P&L. Now, if I talk about the aggregation and disaggregation, see, they are same. Still, the IS1 and IFRS 18 are same in this regard, aggregation and disaggregation. So there also we used to talk about this. It is not good to aggregate things, okay, because we need better representation, faithful representation. Same concept applies here. I would recommend you, if you just read through this once. Very simple aggregation, disaggregation that you've already done. Then labeling. What does IFRS 18 say about labeling of the line items? So IFRS 18 states that use of like labeling is the heading of the particular class of transaction. For example, selling expenses. Then I say miscellaneous expenses. So IFRS 18 says don't use such terms like other income, miscellaneous expenses. So that is not useful because it does not provide users with information about the nature of items included within it. So this is going to give like very bad representation, not a faithful representation. This is not going to make the financial statements understandable, right? So that's what we are saying. So as such, entities should use terminology which describes the nature of the characteristics which the items within that line share. So labeling should be good. The name of the heading should be good. It shouldn't be other investing income. Right? Okay. Let's move on. Management defined performance measures. Let's understand MPMs. So by far in SBR, you guys have heard about additional performance measures. Those are still existent. They are still examinable. So what is this management performance measures? So what are MPMs? See, candidates need to know the disclosure requirements for MPM should be prepared to discuss why these disclosures will provide useful information. So it's like when I am aggregating income and expenses. If management thinks that these should be aggregated and separately disclosed, that particular is an MPM. For example, earning before interest, tax, depreciation, and amortization. Here you are considering both income and expenses. It can be treated as an MPM. But if I talk about adjusted revenue, where I just adjust the income, revenue is just an income, right? I'm not adjusting expenses here. It cannot be an MPM. So MPM is a subtotal of income and expenses, which the entity uses in public communication, which it uses to communicate management's view of an aspect, and which are not specifically required to be presented or disclosed by IFRS. So they are not key performance indicators. They are not your ratios. They are not your gross profit margin or your net profit margin or your asset turnover ratios or gearing. No, these are ratios. These are different things. MPMs are special disclosures which a management feels that, they are required and which are like aggregation of income and expenses, like EBITDA, earning before interest, tax, depreciation, and amortization. So it will vary from case study to case study. A management of company A can feel something else, company B can feel something else. So in other words, MPMs are subtotals of assets and liabilities, or measures of cash flow are not MPMs. Okay, so we are not talking about assets, liabilities, or cash flow. They are not MPMs. We are just talking about P&L, right? So the disclosure of an adjusted profit figure, which removes the impact of non-recurring income, does qualify as an MPM, as long as it is used in public communication. So adjusted profit is an MPM, right? So if a performance measure qualifies as an MPM, IFRS 18 specifies the disclosure requirements. These disclosures should be included in a single note. So if you are including an MPM, you should disclose that this is an MPM that we have calculated, why you've calculated, why do you think it's a separate disclosure for it, why do you think you were supposed to separately show that subtotal, and what is its comparable amount. So you have to give a description of the aspect of financial performance, as well as explanation why the MPM provides useful financial information, how it was calculated, a reconciliation between MPM and most directly comparable subtotal, including income tax effects on an effect on NCI for each reconciliation item. It's just that okay, just know the meaning of MPM, that's sufficient, nothing else. And know what are not MPMs. So your ratios or your assets or liabilities are not MPMs. Okay, so does this mean APMs are not examinable now? No, they are still examinable. What is the difference between MPM and APM? Can you tell me? What is the difference between MPM and APM? MPM just relates to P&L, whereas APM relates to more of the things. It relates to assets also, liabilities also, just the income, just the expenses, and ratios also. Whereas MPM is just related to what? It's related to P&L. So APMs are still there. APM has a wider coverage. MPM are just specific to P&L. Now, lastly, finally, what will be the impact of this particular IFRS 18 on cash flow? See, previously in the cash flow, we were starting with operating profit. And then we were adjusting our cash flow. So I started before, when I started with cash flow with IS1, I started with profit before interest and tax. And then I used to add depreciation to it. I used to add back maybe impairment loss from, because that was deducted, but it was non-cash. So I used to add it back. But now my basis point will be operating profit for cash flow preparation. So can I add back impairment of investment property to it? No, because in my IFRS 18 P&L, my operating profit is coming from operating activities. And impairment of investment property is something which is there in investment activity. So this operating profit anyway does not have the impairment being deducted. So there is no point of adding it back because it was not deducted at the first place. So here your time will be saved. Right? And similarly, there might be some expenses like investment expenses, which are cash expenses, which are not deducted while arriving at this operating profit. So you will deduct it now. Right? So this is the only change which will be there in the cash flow. So as can be seen, the reconciliation will start with operating profit. So IS7 does not use the term cash generated from operations, as this has been replaced with cash from operating activities before income taxes. It should be remembered that adjustments for non-cash items should only be made in this reconciliation if those items are included in the operating category and therefore within operating profit in the P&L. The following items would not require adjustment. For example, investment properties measured using cost model, so depreciation related to them will not be added back because they are there in the investment activity. Gain and losses on financial instruments, which are there in the investment activity, which will not impact cash flow, right? And then the share of profit or losses from associates, that's also their investment activity. It is not being reflected in operating profit, right? So this is what the change in cash flow would also be there because of introduction of IFRS 18. That's it. This is what is important from your IFRS 18 perspective. Just the classification of the profit, okay? In the 5 activities, which will subsequently, of course, also impact your statement of cash flow. That is why I predict that your exam will have, statement of cash flow or statement of profit and loss as question number 1. So this is what we have from IFRS 18. You can find this article on ACCA's website. Okay. So this is related to SBR and FR also. There is an article. All are requested to just go through it. Okay. If you just make one rough reading of it, you will understand. It's very simple. What is more important is its application. So whenever we are going to do the practice now, we are going to apply it. Okay. Even for FR, I will be holding more sessions, live classes related to this. And for SBR, we are meeting for Super 20 sessions. So we will definitely see its application in the new questions. Okay. Let's now move on to IFRS 19, which is the second introduction, which is not there in FR. So this is just there in SBR. So let's look into IFRS 19, a very, very small standard. Let's look into it. Okay. Here we go. So this is just a one-pager standard. IFRS 19. This is Kaplan study text, the new one, which I'm using. What is this IFRS 19? See, there are certain subsidiaries, okay, who are given some concession, who are given some kind of favor that, you know, you can give less of disclosures in your individual accounts. Now, the point is which subsidiaries can avail this concession, can avail this IFRS 19. The only subsidiaries which do not have public accountability, which are not basically public interest. What is public interest? You've done this in audit also. What do you mean by public interest? For example, if I have my securities or my shares in the public market, they're listed. I'm a public company, right? I'm a listed company. Then if I am a bank, I'm working in public interest, even though I'm not listed, but people are at a large scale indulged with me. So I am having public accountability. So for any subsidiary to get a concession under IFRS 19, they have to not have public accountability. Second, their ultimate parent. Ultimate parent. You should know there are two parents. One is intermediate parent. Another is ultimate parent. What do you mean by this? See, if there's a parent and then there's a subsidiary 1 and then there's a subsidiary 2. So this is the ultimate parent and subsidiary 1 owns a subsidiary 2. So subsidiary 1 is the intermediate parent. So subsidiary 1 owns subsidiary 2, but at the end, the ultimate parent is P. So we are talking about the ultimate parent. So the only subsidiaries which do not have public accountability, and in that situation, the ultimate parent produces consolidated financial statements that comply with IFRS. So the ultimate parent should be using IFRS in detail. In that case, the subsidiary can get some concession on disclosures. Now, what are the concessions and why do you need concessions? See, this standard does not deal with that, okay, if there's a subsidiary which is not in public interest, which is not, in public accountability, it will stop making its financial statements. No, it will still make its financial statement as per IFRS only. It will be still actually using the presentation, it will be using the measurement and recognition criteria as per various standards. But you will get a concession on the disclosure requirement. So you will still follow IS2, IFRS 2, IS 19, stuff like that. But you will get a discount on their disclosures if you follow IFRS 19. The only 3 standards on whose disclosures you will not get a discount are IFRS 8, IFRS 17, and IS 33. So these are the 3 standards on which there will be no concession. You have to give their proper disclosures because they are related to disclosures, okay? You don't know about IFRS 17, but yes, these are related to disclosures only. So you will not get any concession on that. So let's just have a quick reading through it. Parent companies that produce consolidated financial statements under IFRS have to choose whether their subsidiaries prepare statements under IFRS or GAAP. If the subsidiary applies IFRS, the financial statements of the parent and subsidiary can have the same accounting policies. However, the IFRS disclosure requirements can be onerous for a subsidiary to prepare. What is onerous? Loss making. Why? Because subsidiary is a small company and making so many disclosures, which is just cluttering the financial statements and the annual report. And that is like you're putting a lot of efforts, time, and energy into those disclosures, and it's not giving you that much benefit. That's why onerous. So if the subsidiary applies local GAAP, there are fewer disclosure requirements. However, the subsidiary may have to prepare and retain extra records in order to bridge any differences. So to reduce the burden of disclosures for a subsidiary, an entity can choose IFRS 19. Only it can choose IFRS 19 if it does not have a public accountability and the people are anyway getting full-fledged IFRS financial statements by the parent because the parent is making consolidated accounts. So subsidiary can be given a relief. But the relief cannot be given for disclosures of these three standards. That's it. This is what we have in IFRS 19. All about concession on disclosures. So you should just know when can you get this concession if you do not have public accountability and the ultimate parent is making the financial statements as per IFRS, and the concession is not given for IFRS 8, IFRS 17, and IS 33. That's it. Do we understand this? IFRS 19, concession on disclosures. Yes. Do we understand this? Give me a confirmation. Okay. Awesome. So, what exactly are the changes in our syllabus of SBR? See, as I just told you, number one change is IFRS 18 about the activities, right, in P&L and MPMs. So it's about the activities classification in the P&L, which will also have an impact on statement of cash flow. And the second is MPMs, which are just a narrow concept of APMs. Yes, they can also be tested in AAA. Now, second is what? Second is IFRS 19. Now, that is something which is again about subsidiaries which are not having public accountability, who can get some concession on disclosures. Very simple. Third is that they have removed integrated reporting. Now, many people in my comment section were like, okay, integrated reporting has gone. There is a difference between integrated reporting and sustainable reporting. Integrated reporting had various, if you go through your text, it was a different concept, a different syllabus. And sustainable reporting, we have IFRS S1 and S2 on them. That can never be gone from the syllabus. They are full-fledged standards. Okay, so they still exist. It's integrated reporting and its related theory, which will not be tested. So these are the changes, okay, which are there in SBR. You can consider them as mild changes. I won't say minor, but mild changes. And I, because of these changes, predict that this is quite obvious that you're going to get a question on P&L and something related to cash flow. Sure shot. So either cash flow or P&L. Okay. Even if in question number 1 a balance sheet comes up, there will be some part of your paper which will talk about it, because this is a recent change. So of course they want to make such questions or past papers where this change is examined, so they will test you on this. So let's wait for the pre-mock by ACCA. Maybe we can see these new things in the pre-mock as well, right? So that's it for the day, guys. If you would have any doubts, you can ask me after the session in the comment section. The ones who are like not enrolled, the ones who are enrolled, you have your WhatsApp groups where you can ask your doubts. And I will be, this video is available after the session to watch for anyone. And yeah, that's it from my side, guys. And I will be now seeing you soon in the Saturday class for my students. And then I'll be sharing the ultimate planner with you tomorrow. So that's it. Thank you. Take care. Goodbye and good night. Thanks for joining the session live, and thanks for your interaction.